Markets are tough. Many people have lost money. Morale is low. So today we are here to provide you with all the information, research, tools, and frameworks to navigate these crazy times. And I'm very lucky to be with not only my brother from another mother, but also my business brother at SwissBorg, Anthony Lesoismier. So tell us, Anthony, what are you here for today so that the crowd can know?
Sure. So Alex called me 2 weeks ago and he asked me, how is the market, brother? And I said, that's tough. We're living in a very, very tough time. And even if we're in the business for 8 years now, I said that's most probably the toughest time we ever witnessed and lived. And he said, yeah, bro, I feel you. It's difficult for me too, but I want to help the community. I have this idea where this is in this tough time, but it's the perfect timing to go back to the basics. And I want to create content to not only help them to navigate the enormous amount of news that there is, but give them as well actionable insights and tools that they can go back to the fundamentals. Because this is, when you zoom out, it's not that bad. And I think that's what we are going to see today.
I love it. Helping the community is probably the most important thing and the thing that we love doing the most. And you're absolutely right. In winter, there's still sunshine. There's still things to do to get ready for summer times. And hopefully we'll get ready for the next big bull market where the altcoin cycle will resume and everybody will be back in the green. Look at this. We feel like we're at home. Anthony doesn't have his shoes on. I'm with my stinky socks. So very, very comfortable. Hopefully you guys like the format. If you have any feedback, by the way, because this is just a test run, right?
Yep.
We really want to understand, just throw information, content at you guys. If you do have feedback, please do not hesitate to put it in the comment section below. Like, dislike, whatever you can to help us, and so we can craft these videos for you and provide you with even better insights in the next episode, right?
Absolutely. And as you see, guys, we're here for a long run. We get very comfortable, and be with us. You're not going to be disappointed.
So let's dive into today's glossary and index of what we're going to cover. 5 components. And here we believe you'll have all of the information, once again, to provide you with the investor insights to make your decisions in navigating the current markets. So number 1, we have the money machine. Ooh, what is the money machine? Number 2, we have technical analysis, which is very simplified, basic stuff. Number 3, we have the investment strategy on a qualitative basis. But then number 4, on a quantitative basis with more mathematics. And by the way, Anthony, you were a quant, right? In your early days.
Exactly, yeah. That's how I started to study the math of finance. And I think even though they don't necessarily always answer very, very precisely, right? It's I think there is a difference between building a plane, for example, where if you apply strict math and physics, you are most certainly of achieving the outcome that you expect, which is having the plane that is flying. In finance, it's different because you can apply the same tools. You have a bunch of tools that exist, but because at the end of the day, it is not the perfect science because it's psychology. And the output of the market is the combination of everyone's opinion that can never be forecasted for 100%. You have to use these tools as indicator. They have to guide you to take certain decision, right? But they cannot provide the perfect answer. That would be too easy. But there are very great tools that you need to use, especially in this very tough time. They help you to filter out the noise and to give you a clear signal. What is the things that, on average, regularly are working and I can apply, such as, you know, if you're a great boxer, you will do a jab, right? The jab would be your money in the bank when you don't really know how to overcome the opponent. So it's not a complex strategy, but you know for a fact there is statistics, there is enough reliance on this technique that you can rest within this specific technique. And that's what quantitative analysis help. They help us to gain clarity when it's very difficult. And that's the perfect tool for now.
Yeah, beautifully said. So you guys heard that. We're providing you with the tools. And I must say, when I see Anthony using like Excel or Google Sheets, this guy in terms of math, the way he sets up all the formulas, it's really trippy. It's so fast with all the shortcuts. So we have the right person in the right room for you guys. That's our whole point. And then the 5th component is to show you how to potentially use these investment strategies with the SwissBorg app. So hopefully you guys will enjoy. Do you like the agenda?
I love that agenda.
Yeah? Okay, fantastic. So without further ado, the money machine. Now, I would love to ask you, Anthony, before we jump into what is the money machine, would you agree that the money machine is the right terminology for what we're going to cover? And the reason why I ask you that is I call it a machine because sometimes financial markets can be artificially created, right? It's not always organic. And it's sometimes disjointed with the economy, and there are ways where financial markets can go up even though the economy is not necessarily looking good. So I feel like it's a machine, as in we can have different parameters. Is it the right terminology, or is it just overboard?
I think it's a very well-fitted comparison. And when you look at the history of financial markets, even if you go back to Mesopotamia or back in the age where you can have a sense of a market, every different era of financial market has to answer to a specific narrative or a specific mechanism. With the invention of fiat currencies, more and more money become the predominant factor for markets. And it's especially true since we have this new effect of quantitative easing. So most of the financial analysis that you can do today, the market analysis, is driven by the analysis of liquidity, right? And as you say, it's a money machine, it's a liquidity machine.
Liquidity machine, yeah. Exactly. I was hesitating with liquidity or money. I was like, what should we put? What should we put? Yeah.
Yeah, and that's really what is driving the market. And when you understand that, then you can start to read all this news and we live in a world that is overflown with news and information. So you have to have framework. And as you say, the machine, because again, how does this modern machine that works? They work with data, right? So I think machine is very well adapted to money because of liquidity, and machine because we live in a world with so much input, which are called information. So they need to be processed through a machine.
Beautiful, great. So that's a good start, right? We have the right terminology. So let's have a look, guys. And by the way, I must say, and Anthony, I think you would agree 100%, today's framework is overly simplified. Obviously, It's a lot more technical, but if we go too close to the branches rather than seeing the forest, it's not going to help people today on giving them, as you said, some basic tooling to make decisions, right?
Absolutely. I think we didn't approach this theme and this video today as economists or a macroeconomist.
Yes.
So we don't want to be 1% loyal to the theory, or we want to provide you the necessary tools that everyone can use.
Exactly.
Very simple, very basic principle that you can use in your everyday understanding of the actuality to transform that into investment decision.
Absolutely. And to transform that into an investment decision, let's start, guys, with the 3 pillars for a bull market, and specifically risky assets. So here, if we look at the first one, we're going to cover some really basic geopolitics. And then if we look at the next component, we're going to talk about the US dollar, which is also the global reserve currency. And then we're going to talk about the Federal Reserve, which is probably the main component, the engine of this money machine, right? And I think in terms of the legend itself, geopolitics, so the presidents that will propose laws and policies, executive orders. We have the Federal Reserve that manages monetary policy, and we talked about the global reserve. And then when it comes to the legend itself, 2 arrows that we have in green what is directly controlled by something, and with a dotted line what is influenced. So far, and things may be not perfectly accurate, but would it be fair to say, Anthony, that we know that the president controls the executive order that also has influence on the Federal Reserve, doesn't control the Federal Reserve, but has influence because he can appoint people who are working for the Federal Reserve. Does that make sense?
Yeah, I mean, theoretically speaking, the Federal Reserve is an independent entity.
Yes.
So they are not a political entity, and I think they always start their speech with that precision. And so that's a very important thing to know. Of course, because Federal Reserve mandate is to decide on the monetary policy as a function of the economy.
Yeah.
And the first mandate is inflation. Unemployment rate as well is one of the variables they look for. And what you show in the graph is law and policy have a huge impact on how the inflation will react, right? So they govern how the economical machine of the specific country is going to operate.
Yes.
Right? And that has a direct implication of both unemployment and inflation. Unemployment as well, traditionally in the past, used to influence a lot inflation. If you have low employment, you have less people are earning incomes.
Yes.
You have, it's very easy for companies to find people, so they don't need to increase salaries. The result of that is low inflation. When you have an economical engine that works in full regime, then the paycheck are going up.
Yep.
People can afford more, they can sell more, and then the inflation goes up.
Goes up,
so,
yeah.
that the way it used to work traditionally. Now it's a little bit mixed.
Yeah.
Right? Why? Because we have automation. It's useless to talk about AI because it's a full entire new topic.
Is already,
So it's more mixed, and economy never worked perfectly according to mathematical formula or theories, as opposed to physics, right?
Mm-hmm.
So you cannot predict for sure, for 100% for sure. But yeah, there is influence.
There is influence, right? And that's really important to understand, guys. So once again, green arrows is control, direct control, and then dotted is influence. So you guys can see here, the Federal Reserve has direct control on Fed interest rates, which is a very important component to financial markets and bull markets, as we all know. So the president, for example, in this case, we're talking about Trump and his administration. Why? Because the United States accounts for 90% of financial markets, not only the stock exchanges, all the biggest financial institutions, right? So I think it'd be fair to look at the US as one of the main drivers of the financial markets, right? And then you can see here, so the president controls taxes, tariffs, regulations, which, as you said, is kind of the root cause for a lot of what the Fed does and the results of the economic indicators, right?
Absolutely.
In some ways. Right now, you guys saw the markets are very shaky. So stock markets crashed, right? Crypto, it's like some of the major assets lost 50%. So some people are saying, oh my God, it's already a bear cycle. Look at how we're getting crushed. And then there are few people, which you mentioned before, like Pompliano, who are talking about this FUD may be deliberate from the president to have pain in the short term, to maybe have more gains in the longer term. Do you see that as well? Do you think they have an agenda with the current administration and it's normal to go through some pain?
Yeah, it's a very legit question to ask. Of course, we have to speculate because we can never know for fact. I love the argument that I think it's very clear that Powell and Trump, they're not best friends for sure, right? And I think in the first speech after Trump was elected from Powell, he mentioned that very clearly. His speech was somehow very offensive to what Trump can do. So Trump doesn't have a lot of leverage on the Fed beside trying to mess up with this indicator that we look for, which is unemployment and inflation. And tariff have a direct implication on this indicator. So as you say, he's trying to play with what is in his hand, right?
Yeah.
It's a chess match right now that he's playing with our money, with our emotion, but it's playing in real time, and we have to witness this, and hopefully it can be resolved into the most positive manner for everyone. But at the meantime, Republicans, they are very well known to play in the field of entrepreneur, of businesses,
Yes,
right? So
absolutely.
Most of the time, and you've seen, right, they're already talking about potentially not applying any fiscal tax on crypto gains and this type of thing. So traditional Republicans, they have a policy that is at the advantage of capitalism, which means in return, there is less product for the economy because less tax.
Yes.
So there is less revenue for the country. So they have to compensate. And one of the ways to compensate is if you have a stock market going up, then you have more tax, people materialize more gains, and overall your economy is still in a very, very positive territory, right? So I think it's not in that would be very surprised if Trump will not care about the market. So his strategy is, I think, to influence, to have the Fed band to him, because part of his mandate as well was, part of his claim, and that explained the Dodge situation with Elon Musk and all this austerity but they practice trying to having the state spending less. But there is only a limit of what they can do, right?
Yeah.
The biggest component of the deficit, the US deficit is the debt, right? So they have to force the Fed to reduce interest rate because that would cost them a lot of money. And Trump was elected on a promise that he will be the savior of the United States and starting to have the deficit going down.
Yeah, and he wants a surplus, right? Which is a crazy, target or challenge, but why not, right? Yeah. And I think a lot of people, for you to watching out there, so here we have a cool succession of events, right? We see that the fear, uncertainty, and doubt that Trump is creating in the short term potentially will increase the demand for bonds because people are afraid of risky assets. And by increasing the demand in bonds, that lowers the yields. We see it already in the 10-year yield, right? It's dropping. And by lowering the yields, it eventually will reduce government spending because they have to pay less on their debt. Is that pretty much how you see it unfolding, or?
Yeah, and it's happening. If you've seen if you look at the moment Trump started to mention tariff to this day, the 10 years, US 10 years, have been going down.
Has already been going down, right? Yeah. And so I'd love to ask you, and you told me specifically, Anthony, that when the yields lower, the US dollar also weakens. So we can see this influence arrow going to the weak dollar. Is it important for us to have a weak dollar? If you don't mind kind of telling me why you wanted to connect these two dots.
Yeah, traditionally, there is an index that is called the DXY.
Yeah.
That is the US dollar versus a basket of different currencies.
Yeah.
And is usually seen as a strong indicator for market to go up or down. There is a correlation to that. And I think everything is linked. So it's hard to explain one variable.
Yes.
To say, because the dollar is weak, it means that the stock market will go up, or risky assets in general are going to go up. It's very hard, right? The thinking process is to say, if the US is going down, it's because the rates are going down and there is more liquidity in the market. And if there is more liquidity because, for example, the dollar is cheaper to borrow, risky assets should go up. Yeah. And we're going to see why as well. It's because most of the investors, they want to protect themselves from a currency that is perpetuating.
Exactly.
There's losing value in perpetuity.
Yeah. So
this is always very complex, and that's why this scheme, even we're starting to see a lot of arrows into this very simplification of what
and even this is simplified.
So
it's way more complex than that, right?
Yeah. But it shows as well already by the number of arrows that everything is so linked.
Yes.
By design that is hard to isolate one variable. But we like to do that. We love to say, because this is going up, this will go up again.
Yeah.
Right? And everyone...
That's how we're wired, right? Cause, effect, cause, effect, cause, effect.
Exactly. We want one input for one output. And that's why every macroeconomist or even in crypto, we have Raoul Pal, that is one of the most predominant figure. They're trying to say, okay, let's simplify to one metric.
Yeah.
And they use most of the time liquidity.
Yeah, M2, right? Yeah. Which is coming up next.
Yeah. Okay.
So, but thank you so much I think your message there is really important, guys, because you talked about how it has to be multiple indicators to really show cause effect, and you cannot take them individually, right? Because it's all intertwined, right?
Yeah.
In some way. So that's a really good point. And so we can see here, guys, so the government spending has an influence on multiple components, which are some that you've already mentioned. So we have energy, which is very important. We have employment, which you mentioned, which is very important. And we have GDP. And if we go a little bit further into what is this linked to, we have the CPI, inflation. We have employment, as you just mentioned earlier, about how employment was connected to interest rates as well. And then lower debt to GDP ratio. Are these, when we look at what the Fed looks like, these are really important indicators for the Fed, correct?
Absolutely, yeah, absolutely. That's part of the main mandate they have is to have inflation below 2, so that they are long-term mandates, to have good employment rate, and of course not to be in a recession. So GDP is part,
Amazing. And so here, guys, these factors are what the Fed looks like. So it has a direct correlation to the interest rates, right? Those numbers which we see in connection here. And then that goes, if we lower the interest rates, that has an influence, as you said, on the liquidity. Do you mind, Anthony, giving us a little bit of a very general explanation on what is M2 and what is global liquidity?
Yeah, M2, I mean, you can have a look, of course, on the Wikipedia and trying to understand better, but this is a metric that helps us to assess what is the current circulating liquidity, right, in general in the economy. And it's very basic. The way we have to think about it is the more liquidity there is, the more there is institutions, there is people, there is a bunch of economical agents that need to know what they do with this liquidity.
Exactly.
They don't want to keep the liquidity into cash because cash is losing value, right? So what they want to do with this liquidity is to invest into what they believe is the assets that are the more sustainable on the long term. So what are the assets that are not depreciating in value? And even if you look at Bitcoin, for example, of course, in the course of the past 10 years, right, we went from 1,000 to 10,000, 10,000 to 100,000 recently. If you look at this asset in dollar, but how much in the past 10 years the dollar has actually lost value, right? Mm-hmm. So if you start to look at Bitcoin, for example, in other assets, such as the gold, for example, right, you will see a different picture. If you look at the stock market, which is non-stop going up, and if you start to rebase the stock market into gold, you will see a very different picture as well. So yes, risky assets are going up in terms of fiat currencies, but fiat currencies are going extremely down as well, right? So you have to understand that informed economical agent, and you can be one of them if you adopt the right habits that we are here to help you with today. They want to escape the machine of devaluation of money.
Yeah.
So what they do with this extra liquidity is they invest, and they invest into assets that keep their value across time.
Which makes so much, and it's a great summary of how the whole thing works, right, Anthony? Because as you're saying, the dollar weakens, you don't want to hold cash. Bonds go down, you still want to make money, but bonds not bringing you back money. And then if you have a positive sentiment about the economy and interest rates go down, it's easier to borrow, then that liquidity will flow into riskier assets. Is that pretty much? Yeah. I know it's overgeneralizing, but
that's the way you have to see it. And even again, the most advanced people, they will explain it this way. If you have another supply of liquidity, you have to expect that risky assets are going to go up, right? And that's what we are seeing since 2008.
Yeah.
Before we transfer the public, into the private risk into the public risk, right? That when we decided collectively, the power in place decided to bail out banks. That was the moment where we started to transfer private risk into public risk. And the way we solve this equation is by devaluating the money. And since then, it's a ticking bomb. And every investor has this reflex to try to invest as much as possible into risky assets because they know for a fact that the cash they are sitting on is going to worth much less into the upcoming years. As normal economical agent, the way you feel it is real estate, right? Arguably, the real estate in at least in every developed economy has gone up crazy in the past 20 years.
100%. And that's exactly what I wanted to say. And going back to the concept of the money machine, I'm just going to quickly show you guys, and then the money flows into riskier assets, right? Just as the last part of this. And this is one last point I would love to share, Anthony, going back to the concept of the money machine, specifically machine, is because, for example, the bull run we had in 2020 to 2021, actually the economy was really struggling. Like it was a really bad economy. That's where most of the inflation happened. But because we printed money, because we did helicopter money, we're dropping money to people, there was more spending capital and flow liquidity to go into crypto. That to me is not a real strong economy. It's manufactured strong financial markets, but with a weak economy. And that's why I call it a machine. Even when we looked at the bull run after the bubble.com era, you could borrow money, like banks would pay you to borrow money. And so we had a really long bull cycle. even though the economy was not necessarily booming on all cylinders. And once again, that's why I call it a machine, because a lot of these bull markets are actually artificially created. Am I too critical on this, or what do you think?
No, absolutely not. I think again, I was too young because I started my career in 2008.
2008.
At the peak of the financial crisis. Actually, I started in 2007. But yeah, I mean, I think before quantitative easing and before the crisis of 2008, maybe I remember when I started into investment funds, there was what we call the value investor. And there was we have defensive stocks that usually perform well when the market is not that good. And we have more offensive stocks that perform very, very well into other market. And I think the quantitative easing, that was something new, completely changed the picture. And now it's very much driven by liquidity.
Yes. You've
seen the stock market being ultimately driven by 7 stocks, right? We call them the 7 fantastics or something like this. Yeah. And so a bunch of the thinking process has been changed across time. And before it was very much value driven.
Yes.
And that's why guys like Warren Buffett, even though they are doing very well, they were such successful investor, and then things changed.
Exactly.
And most probably will change again, right?
Yes.
So I think one day or another, this logic is going to break.
Yeah.
Because that's how economy operates across history.
Because and it's a really good point, and that brings us to the next slide, which is where does the liquidity flow after this, right? But before jumping into that, I think you said something really important, Anthony. It's like people usually invest or take risk when they have a positive sentiment of the future economy, right? The financial markets are usually always before the economy booms, right? Because they have to place their bets and make money as the economy booms, right? But as you said, because of this money machine, things got a little bit disjointed. And I'm going to give a prediction, guys. And it's not just for your moral support or even mental status to make you happy. But I'm going to say right here that I am super bullish, at least in 2026. And the reason why is because I think what Trump is doing here with the short-term pain is trying to heal the actual local markets or local streets before Wall Street. And I think he's really trying to solve some big economic problems that will hopefully reflect in the financial markets. What do they call it? It's like Wall Street and Main Street.
Main Street, yeah.
Yeah, he wants to solve Main Street to have a real Wall Street rally and a real economy that is not necessarily manipulated by the machine. So I'm just going to say, guys, I'm super bullish, but maybe, Anthony, you don't share the same feeling. You're kind of on the fence.
By nature, I think by working in the financial market and in crypto, you have to be optimistic. And I'm very happy to where we are, right, at the place we are. Now there is as well, it's hard to classify everyone everything under the same umbrella. When we talk about crypto, there is Bitcoin, there is Ethereum, there is a bunch of altcoin, there is Solana. I think what we've seen during this cycle, which was not true in the previous cycle, is more dispersion.
Yeah.
Right? Where the meme coin cycle, super cycle, I mean, it was promised to go much, much higher, but it still did a very good run, right? And and we have some of the coins that didn't perform at all. For example, gaming, that was a leading narrative in the previous cycle, didn't see anything, right? So I think what we are going to witness for sure is more and more dispersion into the performance of every assets. I guess not only, as you say, there is the macroeconomy that is heavily influencing overall the market, but as well there is trends such as automation, humanoids. I'm a huge believer that what Trump and Elon are trying to achieve right now, they are trying to automatize states as much as possible, which means we are welcoming from the White House humanoids and AI and all this new technology to our economy, to our daily life. What are the implications at the economical level? That's very interesting. Maybe we are going to have it's already the case, but the predominance of companies such as Tesla, even though they're in trouble at the moment, but it's hard to imagine they're not going to be part of the picture in the upcoming years. Maybe they are going to be the biggest stock. Maybe Bitcoin is going to be, and few other assets are going to be the one making it in crypto? It's hard to know. I think that's I'm not questioning the assets in general. I think the good assets are going to increase in value. My thinking process goes back to understanding what are the results after this different cycle, what's going to be the effect on the dispersion of different assets that exist today and might be different tomorrow.
And that is the perfect segue. Look at this, Anthony. You literally predicted the next slide.
Automate the world's most proven investment strategy in under 60 seconds. Keep things simple. Try AutoInvest today.